Thank you, Peter, for all these suggestions. So far this morning, in this topic of the first 20 years of economic and monetary union, we've had two, I think, very rich presentations about the ECB's monetary policy. And we've also had the very interesting presentation by Jean and the discussion by Shebnem on convergence. So no doubt in this panel we'll return to these topics, but my guess is we'll also visit many other topics in this very broad agenda about economic and monetary union. I think when we have a calendar like 20 years, I think there's always going to be three parts to the discussion. One is understanding what actually happened. Two is think about the counterfactual of what would have happened with the euro, but with a different institutional framework. And then the third, of course, always is what would have happened without the euro. And in the President's speech earlier on, you know, the counterfactual of life without the euro is always interesting to think about. Of course, there's also the temptation, given the euro was founded 20 years ago, to say everything that happened in the last 20 years was due to the euro. So part of the challenge for the panel will be to differentiate between all of the events that happened, whether that's the rise of emerging markets like China, whether it's the global financial cycle, including the crisis, whether it's the role of demography and technology driving the low movement in the R star, whether it's the change in the European Union through the entry of new member states, or whether even it's just simply the spectacular rise and fall in price of oil, which is really lurking behind a lot of the monetary policy discussion. So by 1 p.m., all of this will be sorted out by this exceptional panel. So the format is each of the other panelists will make an initial short presentation. And they've all been very, they've given me exact timing of their interventions. We'll have a discussion, including, I hope, many interesting questions from the floor. So, Laurence, over to you.
Thanks. Thanks. It's obviously super difficult to talk about after Peter, both because of the depth of the analysis and because he's got so many anecdotes and an incredible talent for speaking. So I will be a lot shorter, and that will be one difference. And what I will try to do, leveraging on what you've presented us, is make a distinction between what we can ascribe to policy in terms of performance and how this is to be distinguished from the institutional framework. So I will pass over this very quickly, but just to say, I think it's very important that we make this difference because we won't correct policy mistakes with reform to institution, and conversely, we'll not be able to make better policies when the real issue is about institution. So I will go through the real fiscal, monetary, and financial aspects, and let me start with the real one. So that's just a word to say that in terms of trying to close the gap with the US, it has been a challenge, and a lot has been said about the first 10 years of the euro, so I won't get into there. But what I would like to highlight is how much it has the gap with the 9 OECD best performing countries, which are not in the euro, has stabilized, and that's probably highlighting a lack of structural reforms, even so there were quite a lot of efforts during the crisis. And one of the main tools, actually, that was designed at the beginning of EMU for adjustment was real adjustment. And that's the first point I would like to make. Is when you look at this slide, you can see that the countries which had wider deficit or widening deficit in the first 10 years of the euro actually undertook a very strong wage price adjustment and corrected this current account imbalance. But conversely, or we could say that it was very much one-sided because the countries that had expanded current account surplus have not gone through the same type of adjustment and actually the wage price evolution has been much more muted. So the first thing is we were relying a lot on this wage price adjustment in a currency union, and I think it's fair to say that it's been at best one-sided. Second thing is going to fiscal policy, and a lot has been said here, so I will focus on a few points. But one very positive one is in 2009, the EU, like the US actually, and in the EU especially, there was a concerted effort for a very large synchronized stimulus. And that shows that the EU can really act with force when it decides to do so. Then we enter the period of the fiscal tightening that Peter mentioned. And I think we should acknowledge that it was in part largely explained by the sequence of sovereign downgrades that we were going through. So obviously, with the benefit of hindsight, it was a synchronized mistake on both sides of the Atlantic, given where the output gap were. But perhaps what was more specific to the euro was that the adjustment took place while the output gap was still widening, whereas if you look at the US on the right-hand side, the output gap was already shrinking or started to shrink. And I think part of the reason is that in the euro area, the adjustment was ruled at the individual country level and did not take into account spillovers that would form a euro area-wide stance. A lot has been said about the rules and how they constrain the individual country adjustment, and a lot more will be said by the panel, so I won't get into this, because what I really want to focus on is the coordination. And reforming the rules will actually not address this issue of coordination, which in turn, and Peter mentioned it as well as Olivier yesterday, has hindered stabilization. When some countries lack fiscal space, and when the economy is weak, a euro area fiscal stance which is exclusively driven by rules focusing on individual country situation is very likely to deliver insufficient support. First, the overall euro stance may not be enough to stabilize the euro area as a whole, and even for individual countries, it may not be enough because there will be leakages across countries. In addition to this, the absence or the lack of coordination increases the likelihood of adverse market reaction, and we've seen that in the first part of the crisis, and the Jackson Hole speech by Mario Draghi actually mentioned it. And conversely, obviously, if coordination can create fiscal space because it's strengthening confidence in the capacity of the region to address shock. And what I'd like to add is not only a euro fiscal capacity can make coordination simpler, but it would also ensure a stabilization response commensurate to the shock or the demand gap. So that's for fiscal policy, and let me now move to the monetary part. If I dare, given everything that has been said this morning. So I will just focus on a very few points. First one, liquidity provision. I think it's fair to say that the ECB has provided ample liquidity, fulfilled this role of lender of last resort to banks through various means. Even so, we had the 2013 episode that Peter mentioned. Now, from the outside and as a former market participant, the SMP did not appear as a nuclear weapon to markets because of the self-imposed size limits ex ante, and also because collateral policy was dependent on rating, which turned out to be pro-cyclical. And that has contributed to destabilize the sovereign debt market at the time, and it took until the summer 2012 that we mentioned several times for the ECB to appear as the pillar of the euro area stability. Turning towards more monetary side, early in the crisis, then Peter mentioned, we can say that interest rate hikes, again with the benefit of hindsight, were a mistake. And it took until 2015 for the ECB to move into QE on top of the larger liquidity support and negative rates. Well, the Fed had started QE on a large scale more than 4 years before. This has several implications, but first it means that monetary accommodation was not only early in the US, but it was also larger throughout the episode of fiscal tightening. And Peter mentioned how the macro framework was a lot tighter in the Eurozone. So what can be the institutional reasons behind this? I think one source of delay is consensus building and sometimes even unanimity building, and that probably is understandable when a central bank is as young as what the ECB was. But there were signs of these tensions which were reflected in legal cases brought about against the ECB, and that was probably not helpful. And this may have delayed a large enough consensus for delivering QE. Another source of delay, I think, was the very complex political relationship with 19 fiscal authorities as opposed to one in the US. And you will remember that it took the TSCG for the ECB to move in LTRO. And it took the package of fiscal compact plus banking union plus ESM for the ECB to move into QE. So consensus building, as we were saying, were necessary, especially when the fiscal response was so hesitant. And Peter again mentioned the necessity of political support. It's an additional argument why having a fiscal entity responsible for a euro fiscal stance would give a lot more clarity to the central bank in times of crisis and make it a normal interlocutor in more standard times. There's one additional point that we could mention, which is that the Fed has actually employment as a second leg or as prominent an objective as inflation. And to be fair, if the ECB had this objective as prominent as inflation, then we would probably, our critics would have probably be more tame because this objective has been more than satisfactorily achieved. So that's for monetary policy, and now I will move to financial policy, which is the third angle of adjustment. Well, it has been said before, the Eurozone banks didn't clean up their balance sheet and recapitalize as fast as necessary. We just have to remember that some stress tests were passed, and a few weeks later there were bank failures. I think one important point as well is that when the new financial regime was voted, there was no transition to speed up and help balance sheet cleaning. And with the benefit of hindsight, that was an issue. And persistently encumbered balance sheet of banks today and their low profitability is also a hindrance to monetary policy transmission. And again, we have still the sovereign bank nexus, which prevails. So looking at the institutional side for financial policy, we have to remember that there was no framework for banking union or capital market union until 2012, so that was a big progress. But conversely, since then, progress have stalled. There is no common deposit guarantee or insurance arrangement. There is an incomplete backstop, and it's not large enough to avoid national ring fencing. Supervision remains too much linked to the national level for a large part of the banking sector. Macroprudential measures also are too decentralized to enhance a credible unified framework. The SRB has few policy instruments, only the power to issue recommendations or warnings. The ECB can only use tools that influence lenders' behavior, not borrowers' behavior, the latter remaining in the hands of national authority. Then capital market unions making little progress, and to be fair, in addition to the absence of fiscal risk sharing outside of program, then we have very limited private risk sharing. So I was granted slippage of 2 minutes. So in 15 seconds, I'm going to sum up what I wanted to say. I think we have to acknowledge that structural national reforms and the European one are necessary, but they're probably not sufficient when we are in a period like now, and the completion of the single market will not solve all our problems. We have to turn towards the other adjustment policy. On the macro side, I think the main point is that monetary policy alone cannot actually do the job by itself. It needs the support of a fiscal capacity and a fiscal single interlocutor. That's super important. Also, what Peter called diplomatically the clarification of monetary policy in 2003. I think we can safely ask for a review of monetary policy framework now with all the new tools and the evolution of the Eurozone. For fiscal, I think it's super important that we have coordination at the very minimums to complement the individual rule. And obviously, a euro area budget for stabilization would make everybody's life easier and stabilization more efficient. And finally, financial policy, as you've seen, remains too fragmented. And here, I think there's an enormous task ahead of us, the details of which I will spare you. Thank you.
Thank you. Next up is Marcus.
Thanks a lot for having me back. It's good to be back at Sintra. I'm talking about the last 20 years of the euro. So there were a lot of successes in the last 20 years. There was the initial convergence, the inclusion also I would like to mention more generally for the European Union of the Eastern and Central European countries. And there was price stability like the Deutschmark had, low inflation. But of course there was some regional divergence in the inflation rates as well going on in the first decade of the euro. There was huge progress on the banking union, but there are also many challenges left. And let me focus a little bit on the challenges. And as Peter pointed out, I think one big challenge we have to overcome is that, which came really we became aware in the euro crisis, that there are very different ways of thinking how to manage a eurozone or euro area. And this Rhine divide, which is often referred to as the dividing line, how to think about how to manage a macroeconomy, became very apparent. So there are the four dimensions at least: discretion versus rules, solidarity versus a liability principle, very much moral hazard focused. Whenever there are financial problems, is it a liquidity problem or is it a solvency problem? You know, do you have to deal with spillovers and bailouts is the right thing to do, or do you bail in? The Keynesian stimulus and the austerity reform agenda on the other side. And I think this is more broadly, it's not only Germany and France, it's more broadly, but it's most pronounced in the way of thinking in Germany and France. And most recently, and also just came up in the last debate, the euro area budget, do we need this or do we have to focus much more on risk reduction? And there's some big disagreement on these dimensions as well, as ECOFIN just debated in the recent weeks about that. And we have to find this little red thing, should we find bridges over these dividing ways of how to run a macroeconomy. And I think there's some progress being made, and there's also the recognition that there's this difference in the way of thinking, and that's the first step in order to find some common ground. The other challenge is that we have limited monetary policy space. We have this effective lower bound or reversal interest rate. If you cut the interest rate below the reversal interest rate, it reverses its power. It's not accommodative anymore. It becomes then contractionary. And the question is, how low can you go? And what determines the effective lower bound? And there are different effects. On the one hand, when you cut the interest rate, you have the new Keynesian demand effect. So you stimulate demand. That's a good thing for cutting interest rates. And you also cause capital gains on long-dated assets. So if the banks have a lot of long-dated assets on the balance sheets, so there's a lot of maturity mismatch on the bank's balance sheets, then you cause a lot of capital gains for the banks. So maturity mismatch on the bank's balance sheet is good because you cut the interest rates and really create capital gains for the banks. But for all ongoing forward-looking business, you have a negative effect from the net interest income. So the net interest income for banks is going down. So in the long run, you actually hurt the banks. So there's this Keynesian demand effects, the capital gains effects, but then from the ongoing business, from new business going on, you have way lower interest margins, and that hurts you. And the second question is then, how low can you go? We calibrated this in this reversal interest rate paper with Jan Kobi to a -1%. So roughly you can go up to -1%, but you cannot stay low for too long because there's a creeping up effect. And why is that? The creeping up effect the capital gains effects come at one time. You get these capital gains, but then over time, as time passes, you only have this negative effect coming in and because the old assets mature and will be replaced with the new assets which have a lower return because of this lower interest rate environment. So this is not specific to the euro area. That's at the global scale. It's in Japan. That's in the US and more generally. And that's something which requires some creative thinking how to get around these challenges that the monetary policy space is very limited. So what's one way out? One way out is to say, and the ECB moved this direction, let's move away from focusing only on interest rates. Let's focus on risk premia. Because what really matters at the end of the day is the risk-free rate, the short-term rate, then the long-term rate, the term spread, and then the credit spread on top of it. And what determines these spreads is some expected loss component, which is really, you can't avoid that, but the risk premium you can affect. And what's a risk premium? A risk premium consists of the price of a risk times the risk, and the risk itself is then divided in exogenous risk. These are exogenous shocks which you cannot control, but there's also an endogenous component to it. So there's an exogenous shock, and then it's amplified through the endogenous channels, amplification channels, spirals, runs, and all this endogenous risk is emerging if you don't have set up your economy the right way. And that's the question, how can we actually set up the economy in such a way to can actually reduce the endogenous risk? And when you reduce the endogenous risk, you also reduce the price of risk, and that, reduces risk premium, and that you can affect much more effectively by doing the right things, setting up the economy the right way, and intervening also in terms of asset purchases the right way. And one way, just one out of many, is to zoom in to how do we need a safe asset, design a safe asset for the euro area to reduce this endogenous risk, which is inherent in the current architecture of the eurozone. So I would like to focus on the safe asset, in particular because you have this risk-on, risk-off switches. So the market is very volatile, so you cannot really rely on the market so much and also the price signals of the market because the market suddenly switches from a risk-on to a risk-off phase. And what's the problem is once you switch to a risk-off phase, suddenly all the capital is rushing into safe assets. And if the safe asset is asymmetrically supplied by the core of the euro area, then you have this cross-border flow. Suddenly there's huge shifts out of the peripheral countries to the core countries, and that destabilizes the whole system. And that destabilizes and creates endogenous risk, which then ex ante is priced with higher prices of risk, and that causes for a much higher risk premium. But there has to be some structural reform in this dimension, which, in a coherent, very less intrusive way, but reduces overall endogenous risk in the system, which then reduces the price of risk and brings risk premium down, because we can't do much on the short-term interest rate anymore, so we have to work on the risk dimension, and that's, I think, the way to go. Of course, the safe asset, there's also a second dimension, which, many young economists will talk about this. There's some papers dedicated to that on the doom or diabolic loop. There's actually two loops making things worse. Once you go negative shock, it's amplified in this way. Now, what's the other challenge? The third challenge is that you have essentially, if you focus on interest rate policy, you have a single monetary policy tool, but you have a very heterogeneous currency union. And as I said earlier, the euro area fiscal budget, there are very different philosophies. There's one philosophy focusing very much on that. And let me just say on one thing, there is quite some fiscal amplifications. I learned yesterday that the European Investment Bank invested 300 billion euros in new projects or was part of co-financing of 300 billion. So that's also in a sense of fiscal intervention. It's in none of the statistics, but 300 billion, it's about I think 2% of euro area GDP, which is a sizable countermeasure against financial crisis. So it should be included in the debate as well. And as I mentioned, so monetary policy has limited space. So we have no agreement what to do on the fiscal budget side. And there's some tensions again. I think the big tensions are that on the one hand, we really put the accelerator on the monetary policy. The ECB did everything to stimulate the economy, cut interest rates, and many other measures. But then on the prudential policy, we put the brakes on. Okay, we said the banks, you have to be way more careful. The banks were cutting back on this. So there's an inconsistency there. So on the one hand, you really try to push the banks to go into more risk thing because you get a very low interest rate from holding non-risky things. And you should push them into more risky lending. But then you put the prudential measures on and said, no, not into risky lending. And that's somehow not 100% consistent. And on top of it, there is also the heterogeneity, which requires essentially for some not only nationally focused macroprudential approach, but also some Euro-wide coordination on that. So what's the way out on that? And I think we should probably go away from saying macroprudential is purely, think of the countercyclical buffer, is purely an instrument to manage financial stability. Macroprudential policies, Basel, countercyclical buffer, and other things impact tremendously the macroeconomy. It can stimulate the macroeconomy, also take stimulus out of it. And we should really see it as a tool, as financial stability, of course, but also on top of it, stimulate the macroeconomy. And of course, I'm aware that the Tinbergen principle, might make this challenging, but there are many, many macroprudential tools to manage that. And it should be considered as a tool also to manage the macroeconomy, in particular if you have very limited room on the monetary policy side. And on top of it, you can also manage the heterogeneity. And as I saw Lucas, when this symposium was in 2010, I proposed that you can optimize a suboptimal currency area because you can fine-tune at the regional level your macroprudential tools. But of course, it also requires some coordination at the euro area. So let me conclude. So I think we had some great early successes. Overall, I think, and I applaud Philip for pointing this out, if we didn't have the euro, we also would probably have a crisis, and it might have been a much worse crisis, and that's always forgotten. I think just blaming everything to the euro, I think, is not the right way to go. There are a lot of early successes. There was resilience through creativity. We need additional creativity to find some resilience, and Mario Draghi's speech stands out on that. We have a lot of progress on the banking unions. There's still some steps to be done, but we shouldn't ignore what has been done, big achievements. And that the tensions, because we have different ways of thinking about the macroeconomies through this Rhine divide. There are the challenges. We have limited policy space on the monetary policy side. We should focus much more on the risk premium, much more on reducing endogenous risk. And there's a challenge because we have this monetary policy. We put the accelerator on, macropotential put the brakes on. We should see macropotential also as a way to stimulate the macroeconomy. And that also, if we do it at a regional level, can also optimize the currency area as a whole. And one big element to do this, reduce the overall endogenous risk, is the safe asset component to bring the endogenous risk down, and with it also then the risk premium. Thanks.
Next up, Ricardo.
Great. Well, thank you for having me. When I was first given the mission of trying to give a 10-minute introduction on 20 years of the euro, I realized the first task had to be to narrow down. And so to narrow it, what I did was went and read what some of the reflections on the first 10 years of the euro had been precisely 10 years ago. And I think they're well captured by this quote from a speech that Jean-Claude Trichet at the time gave, which was that the euro is a historic achievement and its first 10 years have been a success. But more important than the verdict were the criteria that Jean-Claude used 10 years ago. Its first criteria was the stability of the euro, which he measured in terms of the anchoring of inflation and its expectations. Second, the role of the euro in terms of its use as a currency within the single European market, both in financial as well as trade transactions. And third, in terms of the institutions of the euro, meaning the ability of the ECB and the euro system to focus on price stability independently from fiscal authorities and other parts of the government. I would complement those, though, with an extra sentence from another one of the evaluators of the first 10 years of the Euros in terms of the policymakers in charge then, in this case Lucas Papademos, who said that the Euro has been a resounding success and pointed instead to establish itself as a stable and credible currency, the second most important one in the world after the US dollar. So you would modify the role, if you want, to be its importance not just within the Eurozone, but especially in the world. So my strategy for the next 9 minutes is to copy their 3 criteria and evaluate not the 20 years of the Euro, but the last 10 years of the Euro. That is, to what extent, how has the Euro performed in terms of its stability, role, and institutions, looking at more of the last 10 years. So the first criteria is stability. That is the value of the Euro, its real value, how has it been affected by inflation. And it was already mentioned in the speech both by Mario Draghi as well as communication by Peter Pratt that the mandate, not the mandate, but the interpretation of the mandate has changed somewhat over the years in terms that it was before an inflation rate between 0 and 2% over the medium run, to then 2% or lower over the medium run, to more recently perhaps symmetric 2% over the medium run. And note how the common parts here are 2% and medium run. That is, the ECB has been throughout its history committed to price stability over a medium run horizon. That is, unlike other inflation targeting central banks, the ECB has always been what is nowadays perhaps called an average inflation targeter, or what in the monetary policy literature gets closer to a price level targeter. What matters is inflation over a medium run, over an average of 5-7 years, or whatnot. Therefore, the criteria is that gray line that Peter represented, that is, what would it be a price level target or an average inflation target or an inflation target over a medium run of 2% since its creation. And over the 10 years, like Jean-Claude had noted in his speech, the Euro has been extremely successful insofar as it almost exactly hit the 2% gray line in January of 2009. But over the last 10 years, in particular the last 5, the deviations from the gray line have accumulated. Now, at first, I say myself, because I was on the record saying that back to 2 years ago, I did not think this was a source for great concern. After all, when we worried about price stability and the real value of the Euro, we were worried about 5, 10, 20% inflation. A few decimal points below 2%, especially given the measurement errors involved in building a price index that anyone who's worked in price index is aware of, does not seem like something to make a big deal about. However, and this is why the medium run emphasis, I think, puts the onus on the right, forces us to look at the gray line, the persistence of these deviations below 2%, even if every year there are only a few decimals below, does lead to some sources of concern today, because we are starting to be significantly below that gray line. Now, as Mario Draghi mentioned in the speech this morning, it is important to think that when we think about hitting 2% on average over this medium run, that sometimes you're below and sometimes you're above. And likewise, and Olivier Blanchard yesterday at dinner mentioned the key challenge in a currency union is and always will be, the fundamental challenge is how to deal with relative price adjustments across sectors or across regions, as well as the overtime averaging. So let me try to bring a third different perspective, somewhat complementary with the two of them. Think of the Eurozone as having 2 regions, such that its inflation rate, pi EZ, is a weighted average of pi in a region C and inflation in a region P. And think of the mandate of the ECB as being, as stated and repeated, to try to reach 2% inflation or below, as it has been during most of this decade. But let me also consider a second criteria, that is that region C, being more inflation hawkish or more averse to inflation, would like inflation in its region not to exceed 2%. Now, in a scenario in which the real exchange rate, the price adjustments which Olivia talked about yesterday at dinner, are such that they require that the relative price of the C region falls relative to the relative price of the P region, then these two goals are not in conflict of any way, and one can reach 2% inflation on average while having less than 2% inflation in the C region. However, if we are instead in a scenario where the real exchange rate, the price adjustments, have to occur in the opposite direction, that is, it must be that prices in the C region go up relative to the P region, then in order to satisfy criteria 2, it must be that the inflation in the overall region is well below 2%, or at least somewhat significantly 2%. Apologies for the symbols, but this is somewhat an elementary, I think, algebraic conclusion. Why did I want to highlight it, though? Let's look at the Eurozone inflation subtracted from its 2% target in blue here. And let's in orange put indeed the change in the real exchange rate between a C region and a P region. Before 2013, we had indeed the scenario A, and inflation was indeed very close to the 2% as in criteria 1. But after 2013, what changed was that instead we had higher inflation in the C region relative to the P region. The change in the real exchange rate was therefore had to be positive. And indeed, we had that inflation fell below 2% on average for the Eurozone. Now, all of you are well informed and already have understood what do I mean by the C region and the P region. The C region is the core of Europe, Germany and France, which account for roughly 40% of the GDP. And the P region, I picked Greece, Ireland, Italy, Portugal, and Spain, accounting for roughly 30% of the GDP region, with apologies for the remaining 30% that I didn't put in either C or P in my simplification. That is, what happened in 2013 was that whereas before in the 2000s, the first decade of the euro, the challenge was that Balassa-Samuelson effects as well as capital flows from the core to the periphery meant that prices had to rise faster in the periphery than in the core. That was what was needed for the relative price adjustments. In the last 10 years, and especially in the last 5 years, prices had to rise faster in the core than they did in the periphery. It was therefore inevitable for the ECB to stay within its 2% on average, then inflation in the core, France and Germany, had to be well above 2%. That is the only way that it was possible to have 2%. But instead, for inflation to stay below 2% in the core and the periphery, as indeed it stayed, it ended up being inevitable that inflation in the Eurozone had to be well below 2%. Looking just at the last 15 months or 16 months, we see that inflation in the core actually exceeded 2% now for a few months. And consistent with the adjustment story that I told you, we see that actually expected inflation fell. For the higher is expected inflation in the core, then the more the average has to be below in order to bring it down to the 2%. Second criteria, the role of the euro or its global use. In one way, the Eurozone, the second leg was a success. The Eurozone, no country left the euro. The Eurozone kept growing from its original decade to the ones that joined in that first decade into the second decade. From another perspective, the use of the euro in invoicing or in the holdings of global reserves has significantly fallen over the last 10 years. The euro is still like in Lucas Papademos' quote, it's clearly the second world currency, but it has fallen somewhat. Looking back and trying to assess that euro second role, I would separate in 3 parts from going from outcomes instead to policies. The provision of liquidity in euros, especially to countries that were in the way to joining the euro, as well as in other Eastern European countries where the euro is widely used, and which account for a lot of this usage of the euro, was preserved through the quick deployment of euro swap lines that allow these countries both to defend their pegs as well as to finance their financial sectors when those were faced with sudden stops of their euro funding. At the same time, though, so that was in liquidity provision. At the same time, though, in terms of reducing transaction costs, reaping the economies of scale that are needed for financial transactions, euro markets have entered in the last few years with the uncertainty related to Brexit and to the existence or not of financial markets in euros that will continue to be vibrant. More worrying, though, is the last point that Marcus Brunemeyer has already emphasized, which is with an absence of a euro-wide safe asset, it is very difficult for there to be a larger usage of the euro as a reserve currency, and for invoicing euros, for the lack of that safe asset makes it essentially impossible to hedge the risk associated with that euro. Third and final criteria, independence, and in particular independence from fiscal policy. The fundamental challenge of EMU, which continues from its foundation until its present, is how to combine a single monetary policy with fragmented fiscal policies. The founding treaty said clearly that the central bank should be independent, should not take any instructions from any government, asserting its independence from the fiscal authorities. And the first decade indeed avoided that dominance of fiscal authorities very successfully by preventing any attempt at fiscal interference on the ECB's creation of seigniorage or desire, or better even lack thereof, of inflation away unexpectedly any public debt. At the same time, though, a second, At the same time, though, a second and new challenge has emerged in the separation. Think of lender of last resort theory, which is ultimately or lender of last resort, a liquidity policy, which is where a central bank gets dragged in during a financial crisis happened in the last 10 years. What do I think is the theory and best practice of lender of last resort across the world, or academically as well as in practice? A central bank should start, either to individual banks or to financial system as a whole, should start by lending to illiquid but solvent institutions, the Bagehot principle. Now, it is inevitable that in some states of the world, the illiquid become insolvent. That's just life. Bad states of the world realize. At that point, best practice in theory says the central bank should call the treasury. For now, this is a fiscal operation. The taxpayers' money is at stake, and therefore it's time for the central bank to pass over to the treasury its operations. Okay? Note that this immediately implies that lender of last resort liquidity policies have a fiscal dimension once we hit a serious crisis. You have at some point to call and turn what was liquidity into fiscal, and you cannot avoid this. There's no separation strict between this. The separation only exists when you are in the good states of the world, when a crisis happens. Price stability requires ruling out this fiscal dominance. Now, who can the ECB call when it engages in lender of last resort liquidity operations? And it turns out that the bad state of the world realizes institutions turn out to be insolvent. Now, looking back, I think one can say that when it reached individual banks, either in Cyprus or in some small banks in Portugal or Spain, the ECB indeed forced resolution, said I will withdraw ability of some of these banks to have access to liquidity facilities of the ECB, and force the national treasuries to take the fiscal loss. During the systemic crisis that affected the financial systems of many periphery countries, the ECB, who did it called? It called the IMF and the Commission, and nowadays in the future the ESM, that is by forming the Troika and saying this is now a fiscal solvency is at risk, you must be part of it. And finally, when it came to redistribution across regions, the ECB, following its mandate, changed the rules so that sovereign bonds would be held by the national central banks, and so that all national risk would be held at the national central bank level, therefore separating any risk sharing and any redistribution at all. Now, in light of its price stability mandate, this was indeed fiscal dominance successfully prevented in all three ways. The ECB succeeded in keeping its independence, in keeping its focus on price stability. Note, and I need to note parenthetically though, that in terms of social welfare as a price stability, all three of these bullet points can be argued as having gone against the social welfare. But that is a discussion for another day. Looking forward though, when we look at the second decade, this question still looms large. Will the fact that the ECB faces a segmented fiscal policies, that it doesn't have an obvious person to call in the midst of a financial crisis, imply that it will cut out lender of last resort too early, not internalizing the fiscal costs that this causes on national treasuries? Or will it instead stay in lender of last resort operations until too late, as fiscal authorities, especially of different countries in the Eurozone, play chicken games on who wants to pay the fiscal cost of resolving a bank institution across Europe? More generally, with macroprudential policy that's national, the ECB will find sooner or later, if it has not found itself already, and for that the experience of the UK is an instructive one, that you can create an independent financial stability macroprudential authority, but when a crisis hits, you, the central bank, are the first respondent, and you are the one who has to know how to do that passing. To conclude, in my three assessments, in many ways the second decade you could say was more successful than the first. The challenges were bigger, and yet inflation was under control. The euro continues to be the second largest global currency, and liquidity was provided, averting a financial collapse while preserving the price stability mandate's independence. But this success, if you want, leaves very big questions for the future. Defining the target in light not just of over time and symmetry, but in light of regional price adjustments, seems crucial for the currency union challenge to be met. Investing in the architecture for the euro to grow, such as safe assets, seems crucial for the euro to go anywhere beyond where it is as a global currency. And rethinking, and more importantly, restating what independence from fiscal policy means in the context of macroprudential policies and lender of last resort policies will become for sure come to front row in the next crisis. Thank you.
So I will not try to exactly summarize all that we've heard in the panel so far, but maybe one way to frame the discussion is part of what we heard is essentially looking at the euro area as an aggregate. So just like we might look at the US or any other large economy, essentially what is the best monetary strategy, what is the appropriate role for fiscal policy versus monetary policy in stabilization in a low inflation world. So that's one part of the discussion. A second part of the discussion is a monetary union works better when there's less divergence across the member states. So that's partly about, well, how can we avoid shocks that create divergence? So better policy making at the national level, more similarity, convergence. If there's convergence to trade, through single market and so on, maybe the shocks will be less asymmetric. But it's also the question of what kind of institutions amplify shocks, what kind of institutions dampen shocks. So these are issues about, in a world with banking union, with capital markets union, with a central fiscal capacity, with a safe asset, with macro-pru, maybe shocks will happen, but they won't be so dramatic, and therefore the single monetary policy would be more effective. So before I gather questions from the floor, maybe I'll just ask, starting with Peter, if there's any instant responses to what you've heard from the other panelists. So Peter.
Yeah, I told you very briefly my reactions a bit. I like what you just said now, Philippe, about the thinking about what are the amplifying mechanisms or institutions, weak institutions, amplifying shocks. Because when you look at the past, what you see is that the crisis we had, and certainly the last 10 years period, you could have had much better results had you had, some of the institutions we created later. So I'm not so pessimistic as was expressed also by you, these fundamental divergences that we had, that you explained, the cultural divergences. I think if you have proper institutions, and we are building, and they are not finalized, this is the concern, but the institutions, all the amplifying mechanisms that we have, the panic, the fact that when there is a shock, there is nothing there, and you have to react. I think that we made a lot of progress there. Now it is true, and that's a little bit what Ricardo came, many things I disagree with you, Ricardo, but there is one story, because I don't think you are very well aware of the recent developments that you have in terms of lending of last resort, even for systemic crisis. It is true that the architecture is not finalized today, so there you have a point. So what happens when you have a systemic shock or a systemic institution is hit, in spite of the BRD, in spite of all what we have now, how would the system react in the central bank? For example, providing liquidity in resolution is not yet an issue which has been solved. Who foots the bill, if a big institution gets down or if you have a systemic shock? So we are not yet there, and this is a source of concern. But you should not also say that not much has been done so far. I think huge progress has been done so far compared to what it was before. But I think you're right, Philippe, to say that we have to focus on the amplifying mechanism. It always reminds me of the Lehman Brothers. If you look at how to solve the Lehman Brothers on a spreadsheet, it's not that expensive, actually. The thing is that your institutional framework has not been appropriate, and then you get into sort of panic, situation. We are not yet there. That's what worries me. But a lot has been done yet. So you have to be much more granular in the discussion. So I cannot be. I think the cultural, when you came with Jean-Pierre, and the other colleague, Harold, with your book in Mannheim some years ago, I think it's interesting, but I think it's a very caricatural presentation about, the dividing line between France and Germany, or that. I think we should be careful about caricatures, about cultures. And I told you that at that time. I think it's useful for those knowledgeable people. But it looks like a bit populist, sort of communication. I'm sorry, Marcus, but it looks like tabloid sort of communication when say solvency, liquidity, and you see this. I told you already before, but you have to be careful. I think in this circle it's fine, but I think we should be a bit careful. About, it's not exactly that, and it's much more complicated than that. The question I think which is fascinating, but is your reversal rate. Now you come with 1%. Of course, minus 1% your reversal rate. I mean, so far we have seen some of the banks, including in countries like Switzerland, for example, but we have seen, or in Scandinavian countries, you see countries where the negative rates is quite low and where the profitability has been quite good, actually. So I think, I think they've managed their costs much better than others. Louis, you came recently in the Financial Stability Review with that point. So I don't know what's the reversal rate. What I know is there are many ways for banks to tackle with that situation. And I think, I think you pushed your reversal rate, to -1. I think it was not, was it always -1? I think it was weaker. Was it always -1? Okay, good. Okay. I don't remember, but so that the macroprudential tools for cyclical policy, I think there is a box in the Financial Stability Review. I think we should be extremely careful. I don't think we put on the accelerator on one side by liquidity provision and on the other side on the brake, by prudential. First, the prudential rules are for banks. And the financial system is not only banks. So it is true that one deals very much with a high leverage, high liquidity risk institutions. And then we provide liquidity to them to allow them to adjust to the new environment. But I don't think it's a contradictory policy. It's a very well thought. What you do when you have a financial crisis, you provide liquidity. Of course, there is a moral hazard problem when you do that, but then you tighten on the other side by regulation, and that takes more time. And that's a little bit the Pittsburgh strategy that was there, and that's what we have been doing. So just a couple of remarks, but
thank you, Peter. Laurence, did you have any reactions to the other panels so far?
You take me by surprise here. Well, a couple of them. First, I think when I look at Marcus, I agree. You made me feel very French, and I can assure you that the chart had been and the thinking was done at the OECD with a crowd of Euro and non-Euro people. So I think I would agree on this, that it was a bit, on the, it was true at the beginning, probably, but I think it has evolved quite a lot. And deep down, I think anyway we need to overcome that, because if we continue with this clear distinction between monetary and fiscal policy, we won't get out of the situation we're in. And in the next crisis, I might be a bit less optimistic than Peter, because I think the divide may have gone, it's going to be more difficult to overcome.
Okay. Thank you. Marcus?
Let me just react to some. Of course, what I meant by this French-German, I meant more broadly, and it's a black and white representation. It's just to make it clear, the communication. The reversal interest rate, of course, is very different. It's very dependent how the banks are funding. So if you're in Sweden, for example, you have a lot amount of wholesale funding, so it changes the whole thing. It moves the reversal interest rate a lot. I didn't have time to go into that. So I just want to reiterate that the fiscal side, I think that the European Investment Bank, I think, can play a big role in this dimension. It has played a big role. I think that's something which we should also take into account. And I very much like Ricardo's point that, if you look at the average inflation, having 2% target, then there probably has to be some countries which are above and some other countries which are below. But perhaps we should also, when we do some forecasting, also have more about the divergence across different regions. And if there's an inflation target, I don't know whether you want to have an inflation target for various countries. If you, in particular, want to change the real exchange rate within the euro area, then it might make sense to communicate this to some extent as well.
Okay, thank you. Laurence, again, just to...
Just wait. Actually, a reaction on the safe asset. Because I find talking about safe asset in a totally abstract way is, if you forgive me, nearly a little hypocritical, because where is this safe asset coming from? Either it's coming from a common euro area fiscal capacity, And when we're talking again about having a common stabilization tool, and then it issues debt, and it's a safe asset because everybody's guaranteeing it. And I hope Philip will forgive me this time, but if it's a totally private sector safe asset, then the private sector can do it by itself and without any implication of the public sector, without some sort of guarantee or tax incentive, which shows that the public sector believes into it, then it will not be a totally safe asset.
Okay, thank you. Ricardo?
Let me be very brief, since in my first intervention I think I took a little longer than others. I want to just emphasize this monetary fiscal, which I think has permeated many of the discussions, and many have said to what extent one needs some fiscal, if you want, aggregate demand management to complement that one offered by the monetary one. And certainly in the case of when it comes to stabilizing business cycles, I think that is unambiguously true. I was emphasizing more, and in my presentation I will do it again, the need for monetary fiscal separation, though, which is that it is crucial for price stability that there is no fiscal dominance, and that the fiscal risks taken by a central bank are both highly managed, understood, and not subject to interference. And as I said, I think we understand that relatively well when it comes to, let's say, normal times, generation of seniorage, inflating the debt. We understand to what extent we need central bank independence, and I think the ECB understood that well in the first 10 years. Over the last 10 years, we've understood how conventional monetary policies lead to a series of solvency, if you want, or capital loss type risks to the central bank, and we've understood how we can manage those, again, in a way that I feel somewhat confident that we know how to address that challenge. Moving forward, though, and even if much progress has been done, like Peter said, understanding the monetary fiscal, not cooperation per se, but even just separation, independence, in a scenario in which there's a lender of last resort, in a scenario in which there's financial crisis, and where a single monetary authority has to face several independent fiscal authorities, knowing that bailouts will happen, maybe with mail-in, maybe not, and that the central bank is always at the start of that, I think is still an unsolved question, not in Europe, but theoretically in general, and I think it's one that has to play a bigger role in intellectually as well as in practice. One has to seriously consider, precisely because I think that separation is important for the preservation of price stability, which, being a little bit of a hawk, I myself am very much committed to, beyond the aggregate demand management that is emphasized. And then very briefly on Laurence, I mean, for at least the usage of the euro as a global safe asset, and for it to be more used as a currency of invoicing, as a currency that's important in financial assets, in holdings, I do not think that you need risk sharing. You do not need a Eurobond type instrument. You do not need tax backing. Those would be important if you want to achieve risk sharing, perhaps. But I certainly did not say that. Some may think so, and that's fine. But if all you want is to create a liquid instrument that allows you to have a well-defined yield curve, that allows people to hedge their risk, that allows people to have, like Marcus said, break the diabolic loops that generate endogenous risk, as well as drop cross-border flows that emphasize and that enhance these real exchange rate and price adjustments, for those I don't think you need the fiscal backing. I think you can produce them. Privately, publicly, I think publicly is probably better, as the work for the ESRB on sovereign bond-backed securities, I think, has shown. But those would be important from an architecture sense, even if not providing any risk sharing, and thus not involving any fiscal commitment.
Okay. Thank you, Ricardo. So what I'm going to do is gather some questions collectively before coming back to the panel. And actually, the first person I see is Francois.
Many thanks to all of you. One quick comment and one question. My comment, Marcus, will be an additional one, very short, on the Rhine divide. Allow me a personal consideration. I happen to be born in Strasbourg on the Rhine. So if you were right, it would be a very uncomfortable position. But you might be right that there is some kind of cultural divide, but if there is one, it's probably more an Atlantic divide, with a financial culture in Germany insisting more, too, on stability and rules, and a financial culture in the US insisting more on flexibility and markets. But I will stop here. My question is for Peter. And Peter, congratulations for your 17 slides. They were excellent. You touched upon the issue of the monetary pillar, and you suggested that we should perhaps revisit it and link it to financial stability considerations. Could you elaborate a bit more about that? Thank you.
Okay, I have a lot of hands up, so with apologies for not trying to follow any particular order. Jean-Claude.
Thank you very much. You will forgive me to concentrate a little bit on the first years of the crisis, which were really very dramatic, and I fully agree with what has been said, namely that it was the worst crisis since 2930s, and not only since World War II. Want to echo what has been said on the divergences between states. We could observe that in a single currency area, it was pretty possible for the wages and salaries in the public sector in two countries, member of that single currency area, to diverge over 10 years in the following fashion. Augmentation in one country, say country A, plus 20% in euros, and country B plus 117% in euros. This was not foreseen by anybody. We could not imagine that it could happen. It can still happen, in my opinion, if we are not very, very attentive. And from that standpoint, the invention of the, I would say, the MIP,
The imbalance procedure.
Yeah, because I have the French acronym in mind, namely that control of the divergences, both on the side of the competitiveness, cost competitiveness, and on the side of the overall external imbalances is absolutely key. And I mention that en passant because it seems to me that we pay not sufficient attention to that. It's not the ECB job, but the ECB should be on record for having told all ministers of finance since 2005, you are diverging, and that divergences will create an immense problem. Another element that I would like to mention, Ricardo made the point, history is at stake there, not only because it's the boldest endeavor in the monetary area ever, in my own understanding, but also because when we are in charge, when Wim passed to me the baton, we were already 12. When I passed the baton to Mario, we were already 17. And Mario had to accept more countries himself. So we were 11 at the very beginning, then very rapidly 12, 19 today. Who can say that this does not create enormous new challenges, threats for the central bank concerned? I'm not speaking of the government themselves, but this is something which is not necessarily captured seen from outside, even across the channel or across the Atlantic or across the Pacific, that history is in the making in a way which is very unique, obviously. And let me also mention, to conclude, that practically all new, I would say, very bold, unconventional tools were experienced in the first 4 years. I mean, we had the full allotment at fixed rate. What would have been the monetary policy transmission in the euro area in the crisis if we didn't have this concept, which is still there and permits, of course, at least at the very, very low interest rate of the yield curve, to have the same, exactly the same in all countries, because the banks have access to that full allotment at fixed rate. We had the SMP. The SMP was terribly criticized when decided by the governing council. We even had colleagues that were very, very infuriated. It represented, all taken into account, if I'm not misled, 218 billion euros, targeted on 1/3 of the GDP of the euro area. So it was the equivalent of something like 600 billion in the euro area in a short span of time. And of course, it prevented us from having an absolutely dramatic unfolding of speculation. So it was something which was very, in my opinion, very important for Mario when he said, we can do anything. And that was, we can go and multiply what has been already experienced and was not continued because the government, at a certain moment, had accepted themselves to take the baton. And I was reading again the conclusion, the communique of the Brussels European Council, the 21st of July 2011, where they had reaffirmed themselves that the ESFS ESM could intervene on the secondary market, which permitted us, maybe a little bit too naively, to think that they could step in and that there was the possibility of the government to really step in. Experience has demonstrated it was not the case.
Thank you. So right behind you, Volker.
Thank you for excellent presentations. So we've heard a lot of praise about multi-policy. We've heard that fiscal policy needs to be put at the European level to optimally manage fiscal policy for the euro area, kind of shifting the IS curve for the euro area. But I'm worried that there is a bit of a disconnect to the developments we've actually observed in Europe in the European elections. I mean, we have, Emmanuel Macron was campaigning on the proposals, for example, Laurent mentioned, right? But he lost against Le Pen, right? The majority is Euro-critical, not the majority, but the largest party is Euro-critical. If we look at Italy, we clearly also have a trend there to, even from the government, to more sovereignty back to the national level. I mean, they're not calling for a fiscal government in Brussels. They want to have more fiscal leeway there, while they're calling, and this is why they're calling for the ECB to guarantee their debt. So we have this trend to more national sovereignty and away from Brussels. How are we going to turn that around? I didn't hear any proposals about that, and I'd like to put that question. And maybe one, if you allow me, one plug for the Bundesbank. In Germany, actually, we also have a Euro-critical party, but it stayed at 11-12%, which is more than enough. But I think the steadfast and effective defense the Bundesbank put up for negative interest rate policies, for target balances, for QE in Germany, and the Bundesbank is a trusted organization, and I think that really kept the trust in these policies among the population, as a side plug. Thank you.
Thank you. Stan Fischer. Sorry, Richard, for Stan. Stan.
Thanks. Ricardo, I think you are ignoring history. The IMF as a neutral lender of last resort, which is not fiscal. Ask Schäuble what happened in Greece. It was done by the fiscal authorities. So there is no lender of last resort that does not end up inflicting something on the fiscal authorities, and don't prevent it, because one day if you really prevent it, you'll get into a huge crisis.
Okay, right behind you, Richard, and then Ollie Wren, and then I'm going to cut it at that point.
I won't go into the rather difficult issue of macro-pru and the relationship between macro-pru and monetary policy, but focus on macro-pru. A number of people did. And we have, I think, a rather curious situation in Europe. The macro-pru authority, first of all, the review of the institutions did not significantly enhance the role of the European Systemic Risk Board, although it did for ESMA. And second, we have this, as I say, curious position in which we have the ESRB on the one hand and a substantial macro-pru capacity in the European Central Bank on the other hand. Now, yes, the ESRB is the entire EU, and the ECB is just the 19. But my observation suggests that there's not much coordination, relationship between the two, and that you could strengthen significantly macro-pru policy, even without the power to tell individual countries what to do. You could strengthen macro-pru policy by a better integration between those two.
Thank you. Ollie Wren.
Thank you, many thanks. And my question links to the lessons learned concerning unconventional measures. And it could also link to what Peter was referring to, further clarification of monetary strategy, and Laurence was referring to a review of monetary policy frameworks. Namely, the paper of Philip Hartmann and Frank Smets includes an interesting comparison concerning the asset purchases and their effect. And based on this comparison, it appears that the asset purchases during the crisis probably had a more modest effect on output in the euro area than in the US and in the UK. So in your view, what could explain these differences between the euro area and the US, UK? Is it the timing, because the US started it earlier than the euro area? Second, is it the structure of asset purchases in the US, the QE? One especially was more effective buying private sector securities. And third, was it the structure of the financial system? Because as we know, the euro area has a more bank-based financial system than the United States. So which of these would explain the effect? Because this also may have short-term implications as appropriate, if needed.
Thank you, Ollie. So we've got a range of contributions there, some mix of questions and comments. So I'm going to ask in turn the panelists to respond, but maybe also bear in mind that since we're overrunning, unfortunately we won't go to a second round of questions. So those of you who have more questions, you can just over lunch approach the panelists. So Peter.
So for François, I would be careful not to transform the second pillar into a financial stability pillar. I would be cautious. We have to reflect on this. I think the money and credit now is extremely useful to have a focus on the transmission. I think more important, I mean, that's one point. So I would stick to that. But the question is, to what extent should you, in the conversation, introduce more, in a more systematic way, financial stability consideration, question mark. And I say we have to be careful about this because you have very often different time horizons and you want at the end of the day to take decisions. Sorry to say that, but so it's something you have to think very carefully. What leads us to say that is that when you look at what happened before the crisis, you see this huge expansion of credit, which we don't see today, but huge expansion of credit. And we said, well, there's some upside risk for price stability linked to the second pillar. I think it was a bit short on the ball. You see, it sent very strong signal of trouble much later on. And that didn't really come sufficiently. It came, I know, because I read also the speeches at that time. It came in the communication. But we didn't have at that time a macroprudential framework and the instruments, because you would have increased the rates at that time to master a little bit that it would not have worked, because you would have increased the rates too much, it would have killed the economy immediately. So I say, before jumping to that conclusion, I would be very careful. For the time being, I think it's transmission, but I think how do you bring in the conversation more the financial stability consideration that we have, given also the fact that we say you have fiscal, you have monetary policy, and you have macroprudential, a sort of tools. And at some point, you need to put these things together in the conversation. That's only the thing I said. The question also, which I think, Oli, about the QE in the US, you should ask Frank. I'm not sure they're right in what I have a sort of degree of skepticism about this. But the reason is basically what you said. It's a very different sort of environment. And QE per se, you cannot see per se QE because it was part of a complex set of instruments interacting with each other. And so it's very difficult to disentangle these different things. The only thing I can say is that there was a dramatic easing of financial conditions at the end of the day. And I don't know what the transmission. I think what you said on the risk channel, I have a bit difficulty when you say we have to target directly the risk premium. We do when we buy bonds. We do that actually, so that we do it already. We do it indirectly via the portfolio rebalancing. Are you suggesting that we have to go directly into other classes of assets to compress, risk premia, like credit, high credit risk sort of assets, or even equity premium? I think that's something that you have to reflect carefully before you say that in public. There are many different implications and also political implications if you jump. So we prefer to do it indirectly, basically, except for some classes, well-defined class of assets. But saying that has to be the new policy, I think you have to think carefully about that.
Okay, thank you, Peter. Laurence?
So I'll be quite quick, and I think I'll focus on fiscal for finance and monetary policy. I think I agree with Stan that you need a fiscal backstop for a lender of last resort. You need a fiscal backstop for banks' resolution at some stage. I don't think the safe asset you've described is actually a euro safe asset. The one you describe is the Bund, and we have it. Or we can do risk-weighted assets of what exists in the euro area. And I think that for macro stabilization, we also need to have a fiscal complement today, especially when monetary policy is where it is, and especially when there is such a mounting backlash against the independence of central bank. The burdens need to be shared. And I don't think, again, that actually there's so much difference between France and Germany. I think 2009 episode showed that it actually can be the case that we think the same. Where the difference is probably how much transfer or how France and Germany do organize the transfer. But essentially, when faced with a crisis, both countries react in the same way. And I would just like to finish with a sentence which I can't remember who said that, but I think it's so true that I repeat it. It's Europeans have always underestimated the economic cost of the European Monetary Union, but Anglo-Saxons have always underestimated the political commitment for the European Union.
Okay, thank you. Marcus?
Yeah, so let me just not get up. I'm all about building bridges across any river, also in particular the River Rhine. And the reason is to highlight the differences in order to overcome them. Very much appreciate Joe Close's intervention about the increases in public wages, and perhaps we should have not only an inflation target, but also an inflation divergence target. So if there's some divergence, that we really point out to that. I very much applaud, the macroprudential instruments are integrated in a broader framework rather than just treating it as totally separate. With regard to Olli Rehn's questions on unconventional monetary policy, in my view, what you saw in the United States is that what really worked were the purchase of mortgage-backed securities. So buying US Treasuries as a QE measure did not have much impact, but buying mortgage-backed securities had huge impact. Why? First, there was a rule only to buy new mortgage-backed securities, so it really brought mortgage rates down and supported house prices, and that made a huge difference to the macroeconomy. Similarly, I think, more generally, whenever you depress credit spreads, then it has some impact. If you just swap a long-dated safe asset for a short-dated safe asset, the impact is much, much smaller. And the same thing in Europe, if you buy German bonds, probably has very, very little impact on the German economy. If you buy more risky countries' sovereign debt and bring down their interest rate, it has a much bigger impact. So I think that's where the focus should be. With regard to buying more risky assets, I don't think you should target a risk premium. You should be aware through the risk premium how the monetary channel, how it really works at the end of the day.
Okay, thank you. Ricardo?
I just want to reply very briefly to Stan because I was a little troubled. Because I think I failed at transmitting what I was saying. I tried to make 3 points, and the first one, which now I understand I was probably preaching to the choir, was to say that all lender of last resort and liquidity operations are ultimately fiscal. And I made that point in theory, and you said that's what history shows. And so I completely agree wholeheartedly that history shows that lender of last resort is ultimately a fiscal operation. And that was the first point I made for 3 or 4 minutes. Then I complemented that with 2 points, which was one, that because of that, and because the first lender of last resort in Europe, especially when we have a single monetary and fragmented fiscal, is very often the European Central Bank, we therefore have to think hard about what is the independence and separation between monetary and fiscal in that setting, which I think is a harder problem that history can't teach us much about, because we usually have one monetary and one fiscal that can coordinate much better, as happened in the United States, as we see in the interaction of long Bear Stearns or Lehman between the Treasury and the Fed, which was very active in terms of passing exactly from the central bank to the other, and which in Europe, I argued, is harder and therefore a challenge for it. And then my third point was that the ECB had made some choices over the last 10 years, that those probably preserve price stability, may or may not have led to higher or lower welfare. I left that open. But then looking forward, and here perhaps being more on the other side of the Rhine in terms of market description, I asked for better rules, better understanding, better institutions of exactly what will be the monetary fiscal separation when we discuss lender of last resort. But this all starting from point one, which is lender of last resort and liquidity, as history shows, is inherently, ultimately, always a fiscal operation, but one where the monetary authority is involved, and that's what I think triggered my discussion of that point. So I could not agree more that history shows us that. That was the starting point of what I was trying to bring to the light.
Thank you, Ricardo. Let me just close maybe with 1 minute of reflection before allowing everyone to go to lunch. First of all, I think this was a really fantastic panel, which followed, I think, a very important morning in terms of our understanding of ECB monetary policy, of convergence, and so on. Let me just respond to 2 points that came up with Ollie on QE. We heard this morning that OMT was a version of QE in terms of the bringing down the spreads. So in terms of working out the overall impact of ECB unconventional policies, we have to allow for that. And second, it came up repeatedly, especially from Marcus and Ricardo, and Ricardo's issue about preferences about inflation at a national level. I mean, I think it's a very important issue about regional price divergences, but these are always going to be finite and temporary, because it's not the case you can permanently have an inflation differential. They're self-correcting. So what's interesting about the divergence is, in some years it might be Germany below or above, in another year it might be Spain, and so on. So in terms of the coherence of the monetary union, we all have a common stake in a monetary stability, price stability, but recognizing that these relative price movements may be persistent, but they're not permanent. They're persistent. So I personally wouldn't call this inflation. It's relative price adjustment. So with that, I'm sure you'll all be discussing these topics over lunch, but I think we made some progress this morning. So thank you to everyone, and enjoy lunch.